Welcome to the Trading Zone. Happy Monday, traders. What a volatile week we've had. We're going to get into a recap as we get through. A lot going on in the markets, and I don't want to waste any time getting into it. But Brian, how are you doing?
Good. Yeah, we're seeing the markets up today. Obviously, change in tune of tariffs from the Trump administration about software and chips, and basically Apple getting a bump today on all that news. So, kind of an interesting move. We're seeing volatility come in quite a bit actually today. The VIX off about 15%, with the market up just a little over 1%. So that's a pretty big drop in the VIX and volatility today. Maybe traders are starting to get a little bit more comfortable with where things are going to be headed. And so this should be an interesting show, really, to kind of get into and where we think volatility is going.
Yeah, quite an interesting move in the markets. We got the tech sector up the most this morning, but we also have like utilities up significantly. So it's kind of a interesting mix. Of course, financials looking strong too. Interesting. Let's get into all of it. Let's pull up our show here as we go. Remember, Joe Teague, Equity Armor Investments, is Brian Stutland, a portfolio manager at Equity Armor Investments. We are here every Monday, 10 Eastern, talking about volatility and the market. We're former VIX options market makers, ton of experience when it comes to trading volatility. So we've seen it all, although this is this is a different one for us, just as it is for everyone else, of course. But it's similar to other times. Even though things seem so crazy, everything seems so polarized, everything seems so unique and strange. It's not so unique that it hasn't necessarily happened similarly in the past. Anyways, getting back to the trade war, electronics getting a big boost, certain electronics, but we're kind of waiting to see if there's another shoe to drop. Maybe there will be some tightening on some electronics, but definitely seems like Apple could be a big winner here. Relatively speaking, Apple could be exempt from some of these tariffs. Big win for Apple here, and we'll see. We'll see if it remains to be the case, but it should be good for the American consumer looking to continue to buy smartphones and chips.
Yeah, I was ready to go run out and buy myself a new phone before it was double in price, but I guess I can wait now. Because I don't know, we had tariffs, but now I guess we don't really have any tariffs. So at least that's the way the market's anticipating it, or at least a lot lower expectations. And so Apple, Nvidia, as you see here, getting a reprieve from it, is giving Apple a stock. And we're going to get into that during the show. We're going to talk a little bit of Apple. I think when you look at the technicals, they're kind of interesting. We have kind of an interesting trade on that.
Yeah, absolutely. We're going to look at that, of course. We got big central banks news coming this week. Bank of Canada and the European Central Bank will make policy decisions this week. ECB expected to cut. Bank of Canada is kind of an unknown. They're still kind of weighing the impact of the tariffs and how their inflation is going to change with that. So that's going to be really interesting. The Fed, again, not going to meet until early May. But there's going to be a lot of Fed talk this week. We'll talk about that as the bond market has just absolutely been screaming last week. I'm going to get into a recap of last week, of course, but Jamie Dimon says there's a kerfuffle brewing, and the Fed might.
That's a fun world. That's a fun word, kerfuffle.
Yeah, that's maybe that's the PC way of saying it. There's some cracks, there's some stress in the market. Of course, last week there was a liquidity crisis. We were looking at this. We saw bond yields just flying all over the place, Brian, up, down, all around. Diamond wants deregulation. He wants to repeal some of that Dodd-Frank regulations, which has caused the Fed to kind of stay out of the some of the trading that goes on in the back end of the bond curve. If the Fed can loosen those regulations, Diamond says, hey, that'll take care of most of the problem. You don't have to do any QE that's going to further cause problems. So Diamond just wants to be able to trade the back end of the curve. He wants to have less margin requirements on what he has to hold, just like some of these hedge funds have. I think that'll add a ton of liquidity. Will it be enough? I don't know, but I think that's decent place to start, or maybe the Fed will just do some quantitative
Yeah,
easing.
let's just hold on one minute. We got to talk about this just really quickly because I don't think, to the average viewer probably doesn't realize what's been going on in the treasury market. And when you take a look at it, what tends to happen is since 2008, the Federal Reserve allowed hedge funds or big money to come in and take more leverage on their bond positions, specifically long dated ones. So what tends to happen is some of these hedge funds that really kind of predicate themselves on trading volumes, right? We know that when volatility gets crazy, market making groups like Citadel do very well on their business side. However, what they do to sort of hedge themselves out and make money when markets are kind of calm and trading is very tight, markets are very tight, their business side has more trouble trying to make money. What they'll do is they will short futures contracts in 30-year treasuries, um, and capture that spread between the futures contract and the actual physical 30-year note that is. But what can happen is a futures contract does not need to move, as we find in VIX trading, does not need to move with the actual cash that it settles until expiration. So what can happen is as they short these treasury futures, if they don't go down in value at the rate that the treasury bill is going down, that they're actually physically holding to be hedged, sort of delta neutral, neutral to the market, then that spread can widen out. And because they're losing their leverage, right? They may have, let's say, $1 billion long treasuries, but they can be losing literally up to $500 million because they're leveraged so many times over that a little bit of move in that difference between the futures market of the treasury that's a hedge against the directional move of a bond gets out of whack. And so we are seeing some of that occur. And that obviously puts a tremendous amount of stress on groups like a Citadel, which, now doesn't have quite the margin to be a market maker. And then now all of a sudden markets get even more volatile because there's less liquidity providers in the system. So that's been all out of whack. And I think what Jamie Dimon is saying here is that, like, hey, if there was a little less regulation, the banks would be able to help out and do this because they sort of took this power away from the banks to be able to put this sort of trade on and left it in the power of just a handful of people. And that can cause some liquidity issues. And so there will be some workout in there. I think that's why the VIX is staying as high as it is, because of this basis trade and risk to some of the leverage that's out there is creating more volatility probably than the market would normally get, even though there is tons of uncertainty out there. Don't get me wrong, we would have high levels of VIX, but it really has been whipping around especially when you look at the VIX futures market, which we'll talk about in a little bit.
Yeah, maybe just to put a pin in that, the trade itself is a basis trade, and it's kind of like a risk-free trade. Maybe it's a duration trade, but you're trading a future that's going to expire into another asset, which they have the opposite trade on. So there is a risk. There is maybe the risk is just the spread widening out, and it's kind of only happens when you see a shortage of dollars worldwide, people not wanting dollars, wanting to dump their dollars, and maybe that short term, but the short term effect is a loss of liquidity in the market. These big major market makers are size up on the futures. They're making markets everywhere. So you lose the liquidity in one spot, it happens everywhere else for these market makers, and it kind of dries up. And then we're seeing these wild swings in the market, of course, which we know about last week. I'm going to get into that right now, Brian. Let's do just a quick recap, just so we remember it. Last week, just one for the books. Okay, let's just do a recap. On Monday, the S&P 500, Brian, hit a technical bear market. We saw yields skyrocketing higher. I went on the morning, and the VIX was hitting 60. You had gold, of course, down on the morning, dollar ripping higher. But then we had that rumor on Monday, Brian, which sent the market skyrocketing. And it was just like, what is going on here? Just a false rumor that the tariffs were being paused. Of course, we'll get into it later in the week. It turned out to be a true rumor. But we just saw a huge rip higher, gap higher, kind of setting the stage. Hey, if these tariffs were to have a pause, we were going to see a rip in the market. Tuesday, bam, market reverse lower, nasty close. huge amount of volume trading, yields starting to skyrocket. This basis trade really causing some issues across the market. Liquidity drying up, of course. We're getting the risk off trade in a big way with Bitcoin getting hammered. And then Wednesday, we got the tariff pause confirmed, the largest S&P 500 gain since the great global financial crisis. We should kind of make a note on that. Yes, it was a great day for the market, but these great days happen in really bad times for the market. So that was just something we should make a note on. NASDAQ was up 12%, by the way. A huge amount of shares trading hands. But we had yields going higher still. Even though the market's rallying, we're still getting these yields going higher. So something still seems kind of off here with this bond market. But, Goldman Sachs says, hey, maybe we won't get a recession if this is a true pause on the tariffs. That remains to be seen. I think that's going to be the key point for me, Brian, as we look forward for this week is how is the consumer faring through all this? Are they going to just slow down just because they're concerned? Is that just kind of like worry of a recession going to cause the recession itself? Or are we going to be fine if we can just muddle through here, get these tax cuts, get these dig regulations, and things will be looking good again? We'll see. But then it wasn't over, of course. Thursday, S&P 500 down again. Dollar had the worst day since 2022. We saw oil getting hammered, just a sign of a global recession, and gold, of course, up. Nobody wants dollars. Nobody wants stocks. The only place to hide right then is gold. And, of course, Friday, S&P 500 finished higher. It was the best weekly rally since 2023. But, we had the 30-year up 45 basis points on the week. That's a big move for a week without any Fed talk, really, in yield. So this was just a crazy week, Brian. It was up, down, all around. I like where the S&P 500 is now, but we really need to break some levels to kind of confirm all that.
Yeah, what a crazy week, certainly. We have kind of made lower highs here, so that's maybe an encouraging double bottom kind of move in the S&P. So why don't we kind of get into what volatility is saying, what the S&P is doing? Obviously, we have some events still to look ahead here. Earnings obviously coming up for a handful of names. Fed speaking, and Taiwan Semiconductor, ASML, Netflix. Obviously, Goldman Sachs came out and crushed it today. So I think the banks are actually in a pretty good position with the steepening of the yield curve that we're seeing even going forward. That'll be kind of an interesting play on the banks. And so obviously a big week.
The banks doing great is a good sign. JP Morgan last week was good. I mean, you don't really see like a great financial crisis 2007 situation where you have the housing market collapsing and all these banks were crumbling. That's not what's going on right now. So we still have a robust enough economy, and we're not seeing anything deteriorate yet. We'll see if that changes though.
Yeah. So when you look at the skew, this is kind of interesting because this is almost like a double toppy kind of formation here. Obviously, massive put buying going on in the S&P last week, and that has now subsided to some degree. In fact, I was just looking at things, a 10 delta put, right, which is something like 10% out of the money, has gone down more in value today than something that would be like a 30 delta call. So there's really been an extreme selling out of the downside insurance with people, at least for today. So it's kind of an interesting move. I don't know, maybe it's a little bit overdone, but certainly if people feel comfortable that what was going to be tariffs is no tariffs. I mean, remember a couple of weeks ago when they announced the tariffs here, right? I think the market was getting ready for maybe like 10% tariff maxes on, and then all of a sudden they came out with these crazy numbers and they've pulled all that back. So maybe we need to get back to levels that the market was, just like call it 5,600 or so on the S&P before things sort of fell apart as people anticipated, better than unusual tariffs on people. And, obviously we have a 90-day pause, so something can still happen come July, but certainly you're seeing this skew really change and people sell those puts out.
Yeah, and for me though, I want to see a lower low here. big time. We got the lower high. That's great. Really will confirm everything a lower low. I'm not necessarily anticipating until we get like trade deals announced with Europe and England and Japan, for instance, below this level. And of course, the big one, like our largest partner, or the biggest tariffs with China. I think that's a little bit harder, and that might cause us to stay above here. Again, we'll see. You got the VIX, it's down 31.5 right now, Brian, at the front month expiring on Wednesday, right about 30. So that's still really high levels of volatility. Don't get us wrong. This is predicting 2%-ish moves in the market every single day for the next 30 days. So that's not normal. It's a little bit higher than usual, and I think that's warranted given the concerns.
Yeah, certainly is. Certainly is. If you look at maybe like the VIX futures here, this maybe is a telltale of where volatility is going. A week ago, look at that. I mean, front month up there in the 40s. That's crazy. But when you look down here a month ago, right, we were in the.
I just point out real quick. Last week, Brian, we had the cash here at 46. This front month was right here, and the cash is all the way down here this week. Front month has not done too much, so I think people who are experienced trading volatility have a little bit of understanding, kind of know what to do with these volatility futures. It was a fun ride trading those volatility futures last week. These futures got up here around 40 on late in the week, and it was a fun time to own them down here and not own them up here.
Yeah, we did for our strategies for clients. We did sell about half our VIX futures out when it was up that high. So that was a good move for us to sort of, at some point, you got to take the volatility off, right, Joe?
Yeah, well, exactly. Kind of just using our model and signals, of course, and trading prudently and just kind of understanding the history and what goes on. It makes a lot of sense when you see this gap here to own it, think that this is going to unwind. This actually unwound the opposite way, which happens a lot too. The future traders were kind of right, but look at the difference in how much the futures have fallen versus how much the cash has fallen. I think now over the next day and a half until this expires, we're going to see a ton of volatility in this front month. So it's it's going to be all over the place. Should be an interesting settlement here, to say the least.
Yeah. Now, obviously, VIX future, the settlement coming up on Wednesday morning, so that should all kind of snap into line here. I mean, you look at the red curve there, that's where we're at right now. There maybe is, like, if you were looking at like mean reversion, maybe a little bit more downside potentially to go. I don't know, Joe, like what's your feeling here on volatility as we sort of kind of broken out of a 10% gain off the lows already? Where do you think VIX and volatility should be?
Well, I think it depends on the S&P 500, of course. I think if we can make a relative high here, that'd be fantastic. If we can just get this chart looking a lot healthier, but it still kind of seems like we're going to chop. Maybe it'll be the case where we kind of chop, volatility comes lower, and that kind of gives us the signal, hey, we're not as worried about the downside. We're doing some consolidation. We're correcting in time more so than price right now. We're kind of figuring things out. There's a lot more, unknowns out there, Brian. We still got, more deals to be done. We still got, potential with a makeup with China. There's still the geopolitical stuff going on out there. And I think most importantly, the market is just really waiting to get past these tariffs, start talking about the budget, start talking about tax cuts, start talking about the deregulation. I think that's going to be finally a tailwind, some good news for the economy, which we haven't really seen so far. But I just thought this is funny, Brian. I've been so stubborn on this chart here. These channels chart, I've not given them up. They continue to be prudent. This is just 3 years in the making here. This turned into resistance when we could not get above it. It was a super good signal. Again, this like support didn't hold, and we just absolutely crashed through. But then finding the support down here is just really amazing for me. And then this level again is going to be crucial for me. This 5,500 is going to be crucial. Breaking above here is going to be important. All that said, if this was a mini head and shoulders top right here, Brian, we reached the target. This was the target here. So that could be a sign, hey, the pain is over. We can just kind of consolidate here and not make a lower low. wait it out here. This will be great. The worry I have looking at this in a bigger picture is like maybe it's even a bigger head and shoulders up here, and then we're about to set this other neckline there, and then that would give us just
Oh, that'd be nasty. And in that case, you probably want to get long VIX right now, as we're kind of getting up towards that 5,500. So I do actually like your analysis here. The 5,500 levels is probably something I'm watching. Like you said, there might be some chop, to see if we can bust through that where, the market kind of sits around a certain level here. We get a little bit more volatility come out of the market and see if they can sucker anybody.
I think we need some headlines to make it like a V-shaped recovery, right?
Mm-hmm.
And I think those are kind of hard to find. It's hard to see just like giving up on the trade war right now and just full stop.
Yeah, but if you look back to 2018, 19, when there was this similar 10% drop, little bounce, hold in there, another 10% huge rush out, and then it now went higher because the Federal Reserve was cutting interest rates. Maybe that was the headline that you're talking about you'd like to see.
Yeah, a QE could happen.
Right.
Yeah.
Now, if they come up and shore up the Treasury market, like we talked about the basis trade we earlier in the show, that is almost like a QE, isn't it, Joe?
Oh, 100%. Yeah, shoring up the Treasury market would just be the Fed coming in and buying the long end of the curve, bringing those yields down big time.
That could be the catalyst you're talking about that takes us through this V shape. If we get some news about that, because you're right there on the economic front, on the tariff front, probably nothing more new that's going to be exciting unless all of a sudden China cuts some great deal, which is, in my opinion, highly unlikely. Yeah, I think the catalyst is watch what happens here with the Fed, with interest rates, with the Treasury market, because that could act as like a liquidity provider. Boom, you go through 5,500, and then now you're back out of this warning sign channel.
Yeah, 100%. And again, this, this worry that I have, this potential really, really large head and shoulders, it's going to come down to recession. If this is a recession, like we're going to see this headline. It's, over the next month, we're going to see May jobs be really bad. The recession happening, and then we're down here. Or see bankruptcies. Banks will be doing poorly. If there's no recession, though, I think the different take is just some chop here, and then higher slowly, and then of course the third option, yes, QE. Deregulation, tax cuts, trade deal with China, something could be there. Obviously, those are the three obvious patterns. But just kind of watching this 5,500 is just really crucial for me. I'd love to see that. I'd love to see that, and you see the VIX popping or dropping below 30 significantly if that happens.
If you had to put a delta on whether we go through 5,500 or not, what's your take?
I'm leaning towards that just because since 2008, it seems like the Fed is so much more responsive.
Yeah.
So much more active. In 23, we had, the regional bank crisis, and people are just like saying, oh, everyone's going to fail and this is going to cause all this damage. And the Fed just stepped in, bailed a couple out, and then a month later we had forgotten about it. And it was so easy to do for them. Whereas in 2020 or 2008, we remember how hard it was to get the TARP passed, how hard it was to do anything. It just seems so easy right now for the Fed to step in, snap their fingers, wave their magic money printer wand, and the markets seem to race higher. And again, maybe that'll be inflationary, but inflation also means stocks higher.
Right. And that's true. Inflation does mean stocks probably higher unless, the Fed's going to step in and try and control that. But the inflation numbers were pretty good. So I'm probably leaning towards we're breaking through 5,500 as well, like with the same kind of theory that the Fed has really been more responsive since 2008 to make sure that VIX and volatility can't get too out of hand. 2020 was sort of a unique special occasion where you had things just shutting down, so it didn't really matter. But even then, the government stepped in and had $3 trillion, injected into the market with the stimulus package. So one of the two happens, right?
Yeah. I think more like the Fed just snap fingers and say problem solved. This is the NASDAQ, got the death cross here. people often think this is a terrible sign. It's a bearish indicator. Sometimes it's just kind of like a signal. It's kind of overdone here. But we'll see. Yeah, I'd love to see this. It's the 5,500 level comparison. You'll love to see it tracking above that. We're very close to that, of course, right now. Live semiconductors, just absolute carnage. They were the reason the market, was so awful. And doing a lot better today, of course. We're up 2%. Not doing as good as tech broadly, but close to it, kind of leading the market. You want to see tech leading the market. You want to see the recovery happening here. Semiconductors is just a sign that the economy is growing. So very, very crucial. And of course, the AI trade was very big here. It's basically saying this whole 2024 gains that we had in AI are just gone here, Brian. For me, I don't think that's appropriate. I think AI is here. AI is going to get bigger, and if it's not profitable for the Mag 7, it's going to be still very profitable for the suppliers of these chips. I think the Mag 7 are still kind of like the Apples and the Metas and the Googles are still figuring out how to profit off of the language models, how to profit off of AI. But it's very, very profitable to sell these machines while they're figuring it out. So I don't think that's going anywhere anytime soon. And I think the AI is going to get better and eventually turn a profit for the Mag 7.
Yeah, I mean, I would say, look, obviously there's some levels here. We talked about 5,500 in the S&P. You're looking at SMH here trying to make sort of a double bottom. You're looking at the NASDAQ trying to make a double bottom. I think if it happens, though, because of the discount that's occurred over the last couple of weeks here, setting up for a really good opportunity to, maybe roll more of our positions for people into more growthy AI kind of names, like because we've had kind of a hard reset, like you said, to 2024 on that. That's what I would be willing to look at. I do like the banks also in this kind of situation. We had good earnings so far and a steepening yield curve.
Speaking of.
Yeah. All right. So let's get into, look at the banks. So they're another level where sort of we can not just retest this sort of head and shoulders top. Maybe you can draw that out a little bit, Joe, on the XLF here.
Everyone can see this.
Yeah. I think if we sort of can get back above that neckline, another area of the market that's been hit so hard might be a good area to invest in as well.
Yeah, but it's just kind of a sign of strength. We saw these other charts. You had these 50-day moving average going lower, crossing these 200-day moving averages, especially in the SMH. That's not what we're seeing in the banks. The banks, we still have this rising 200-day moving average, no death cross. So it is the strongest part of the market. And maybe there is strength, actually, Brian. Yeah, there's potential in some of these tech names, these growth names, which have come so fast. But maybe there's just strength in some of the value names, which people are selling too. They've come off a great deal too. Maybe there's some value to be had in, spoiler alert, we'll be trading Berkshire Hathaway in a little bit, where if the economy remains robust, if there's no recession, those value companies are going to do just fine, and maybe a safer spot to park some money.
Yeah, I mean, Berkshire Hathaway obviously had been getting out and moving more in cash over the last 6 months, probably anticipating that the tariffs would be very, very bad for the economy. Mm-hmm. They were 100% right on that because we got a test. Tariffs came out greater than expected, and the market hated that. So Berkshire kind of got that in place, and probably if I would see if they saw some opportunity, there might be some upside. But hey, if there's another indicator here, Bitcoin obviously has had a tough go of it the last couple weeks. It historically has kind of been a leading indicator with the NASDAQ and semiconductor and technology. So I'd probably be watching here another key level, maybe 90,000 in Bitcoin. If we get above there, that could be another leading indicator that the tech space is in good shape.
Yeah, absolute risk on, risk off indicator for me. People want it to be a inflation indicator. Gold is the inflation indicator for me. So gold was a much better performer of course, throughout the past couple of weeks. But yeah, it's interesting to see. It's up today. It's just, and it's not necessarily cratering here, so maybe it's kind of a sign. Hey, things are not as risk-offy, disastrous as otherwise thought. For me, just essentially, if there was like a super duper margin crisis, if there was this liquidity crisis, if I were a high net worth individual, the first thing I'd sell to get some cash would be Bitcoin. So you didn't see Bitcoin just absolutely falling out of bed completely. Kind of hung in there nicely. I think that was decent enough. Let's take a look. Brian, get a couple of trades going on in the past couple of weeks while you're out. Let's take a look at these trades real quick, which we still have live. Remember, if you want information on these trades, check out our website. These go out every Monday before our show. This one went out 2 weeks ago. Looking at a diagonal trade. This was held up very good, great protection, of course, throughout the last couple of weeks. And this one has done very nicely too, kind of hung in there in value. It's basically unchanged since the time putting it on. And the next one was.
Well, hold on. Let's just talk about that for a second, though, for like a trade, because it's kind of an interesting one, right? You bought a put in April to sort of buy protection on a portfolio, and then willing to get back and put back into your position back down at 500. So it kind of initially had a bearish sort of play to it, a protection play. And because of the diagonal nature of it, what happens is the April expires, but now the market's rocketed so far higher that the short put on December starts declining in value as volatility comes in. And so the fact that this is unchanged and it was basically a free protection, right, Joe?
Basically free protection, and allowed me to do this next trade too, where I got long a week later, and boy, was this great timing, Brian.
By the way, Joe, step back a little bit in front of the camera.
Sorry, I'm trying to I'm trying to line up the strikes here so I can see the price of it live. So yeah, we sold. Oops. Here, let me put this in the middle. Maybe I can see this easier here. Can you see?
Yeah.
Okay, so yeah, we sold this 465 put. We bought the 500 call. And we sold the 520 call. This was basically free. It cost me, I got to collect money to do this. And it's currently worth $18.60. So
I mean, just imagine putting both those trades on, right? You had the protection from the diagonal plus this. You got essentially free protection, and you've made all the money on this sort of structured risk reversal plus selling a call, right?
Yeah, it went from a $5 credit to now it's almost $19. It's just fully in the money here.
Nice winner. Hopefully, you got to go in equityarmorinvestments.com. Subscribe now. You get these trade alert updates. Plus, we're updating it throughout the time. We'll probably send another alert out on the update of what we would do at this point with this sort of structure that Joe had put on. But man, what a great call.
Yeah, and this one is a little bit tighter here. Another $500 name. So it's a stock replacement again, but I'd much rather own Berkshire Hathaway this way than having the risk of the downside. Last week, it was down in the 470 or so. So it's come all the way back. It's about 530 right now, probably a little bit higher. And going to be selling the May 500 put, buying the 460 call spread. I can collect money, at least as of this morning when the trade went out. Can collect money. I think it's now worth some money as it's gone higher here. So that's the trade that went out this morning. If you're a subscriber, you saw it, and you're seeing what we're doing here live with us every week. Thanks. Yeah, I feel feel
And
really
you
good.
still like this because there's still some volatility to sell. Like, obviously you're buying an at the money option, right? So you don't think of it as like a long volatility trade, but because of the structure of selling the wings with the expectations that you'll move away from the long strike, it technically becomes a short volatility trade. So you think there's some more premium left to still be had in this market, right, Joe? To sort of sell out on those wings.
Yeah, we got to VIX it. We got to VIX above 30 here, Brian. So absolutely, this is really close to its recent relative high. Recent relative high is about 539. And it's kind of amazing. I think there's a lot of room for bounce back into the tech stocks, but really would be great to see if the economy just kind of can avoid the recession, be led out by the value names. Berkshire Hathaway, trust Warren Buffett. He knows what he's doing. He did not get hit very hard on this pullback, and he had cash on hand. Curious to see what he did with it. I've heard that he's been investing in Japan and some other banks in Japan. Maybe got some really good deals last week or 2 weeks ago while he was doing so.
Yeah, I mean, geez, man, Joe, with these calls on this, our subscription's almost too cheap, right? We offer $30 a month for this trade idea, Joe. And actually, the great deal, if you go on our website, equityarmorinvestments.com, and go click and follow the links, you can get a link to the Tradier to open up an account. If you open up an account at Tradier, you actually get all of our trade ideas, which is about a $50 value for free for 4 months. And man, these are such timely trades. When the market's so volatile, I always need someone to sort of help me out, reaffirm what my thinking is, and give some ideas. So certainly, nice call there, Joe.
Yeah, and it's fun to do. It's fun just to kind of put it on paper what I'm thinking, and even better to make money.
Yeah. So, hey, folks, make sure you tune in every Monday here at 10 o'clock Eastern time. A couple minutes after we go on, kind of, talk about what's in the week ahead, but really then drill down on what the markets are doing, where we think they're going, and then eventually give our trade. And so even if you subscribe to our sort of subscription newsletter, you can come on here every week, listen to like how we're actually thinking about the trade as well. So you can continue to learn for yourself, structure other trades for yourself as well, on top of jumping on top of our trades. So make sure you tune in every Monday. Joe, you got any last words here before we call it a night or a morning?
Yeah, no, I think we hit it on the head. There's a lot to watch in the market. We're still got a high VIX. We've got some levels we're watching out for. So we're still headline dependent. I think we're going to need a headline maybe to get those levels, Brian. But I like where we're at, and just seeing a little bit of volatility compression that might be good for the market. But just again, just watching very carefully and just kind of knowing we're not in the best spot. Things seem kind of good today, but in bear markets, you do kind of want to sell the rips. So if we are in this bad spot where the recession is coming, the worst could still be ahead of us in terms of equity prices. So just watching very carefully for that. Stay tuned for updates. We'll be back next week.
All right. See you next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.